morning and welcome to Business Morning. Thank you for joining us. I'm Chimeze Obi Iwago.
And I'm Ladi Williams. Thank you for joining us. Let's kick off with some headline news. Crude oil prices rose on this morning with Brent hitting $75 a barrel for the first time since April 2019 as investors remain bullish about the quick recovery in the global oil demand and as concerns eased over an early return of Iranian crude. Brent crude futures for August climbed 26 cents to $75.16 a barrel. Pairing earlier losses, it rose as high as $75.23 a barrel. Strongest since April 25, 2019, earlier in the session. U.S. West Texas Intermediate crude for July was at $73.70 a barrel, up 4 cents. WTI for August climbed 11 cents to $73.23 a barrel.
And Brent gained 1.9% and WTI jumped at 2.8% on Monday. Both benchmarks have risen for the past 4 weeks on optimism over the pace of global COVID-19 vaccinations and expected pickup in summer travel. The rebound has pushed up spot premiums for crude in Asia and Europe to multi-month highs.
And manufacturers of electricity meters are asking for an increase on the cost of the commodity following the rise in inflation and foreign exchange rates, among other economic variables. The meter producers, under the urges of meter asset providers after their meeting on Monday, agreed that the Electricity Regulatory Commission should carry out an upward review of the current price of prepaid meters across the country. The upward review of the current price of prepaid meter by NERC is in view of rising inflation, continued upward movement of foreign exchange rates, associated increases in custom costs, increase in container freight costs, and the disruption in the international supply chain.
According to them, these factors lead to a global increase in the prices of raw materials and components for the manufacture of prepaid meters. They, however, noted that there will be a corresponding downward review of meter prices when there is a downward movement in foreign exchange rates and other cost factors.
And the United Arab Emirates has reimposed the suspension of flights to and from Nigeria with effect from today, June the 21st, until further notice. Suspension, which comes barely 48 hours after it lifted a 4-month ban on flights connecting the country to Dubai.
According to the statement on its website, the country's flagship carrier, Emirates Airline, mentioned that in line with government directives, it will not accept customers traveling between Lagos and Abuja, while passengers who have been to or connected through Nigeria in the last 14 days are not permitted to board from any other point to the UAE. On Saturday last week, the UAE's Supreme Committee of Crisis and Disaster Management announced the easing of travel restrictions for inbound passengers arriving.
And for our first conversation, the organized private sector of Nigeria last week came together to share their views and recommendations with government on issues that are of critical importance to it and the Nigerian economy. They suggested a mix of fiscal and monetary trade policies that need to be implemented for economic development. To look at some of the suggestions and recommendations, the Director, Membership Services, Nigeria Employer Consultative Association, Adewale Oyerinde, joins us next. Do stay with us. This is Business Morning.
Members of the organized private sector in Nigeria comprise Manufacturers Association of Nigeria, Nigeria Association of Chambers of Commerce and Industry, Mines and Agriculture, Nigeria Employers Consultative Association, Nigeria Association of Small-Scale Industries, and of course, Nigeria Association of Small and Medium Enterprises. We're being joined by Adewale Oyerinde, the Director, Membership Services, Nigeria Employer Consultative Association. Thank you very much for joining us, Mr. Oyerinde.
Good morning. Our pleasure. Always to have you.
Well, this is this is not something that happens very often where we have different, organized private sector, coming together, MAN, NECA, NASIMA, and all that. What informed this particular meeting?
Well, thank you very much once again, and thank you, viewers. The OPS, as we call it, has been in existence for many years. It's actually the combination of those 5 institutions. We call them, those 5 forms the organized private sector of Nigeria. While individually we have our reason d'etre, we have our main function, we have our members, but at the national level, we have that institution that is called the organized private sector. And the Secretariat of the Organized Private Sector rotates between the big three, between NECA, it goes for NECA for 2 years, it moves to Manufacturers Association of Nigeria for 2 years, and also NASIMA for 2 years, while the 5 form the body. So for the next 2 years, is with NECA now, and probably we've not been in the press as often as we should, but this meeting informed, because of circumstances surrounding the environment, circumstances of the economy, the body came together and shared their perspectives and share their views concerning the economy, and also make recommendations, as you mentioned earlier, on ways which we think government can further steer the direction of the economy, so that we all arrive at that El Dorado that we all are hoping for.
The El Dorado. Well, about 8 key areas were in focus. Let's start with the foreign exchange market. Your members are asking for more liquidity in the market here, and the consolidation of the unification of exchange rate. What is your recommendation to the central bank?
Now, we find ourselves in an unusual situation where the country is faced with multifaceted challenges. And for you to come out of those challenges, first you look at which of those problems can you face that will have a rippling positive effect on so many other challenges. And one of those issues is the issue of foreign exchange. Yes, there's positive of foreign exchange because, as you all know, oil is the major source of foreign exchange for the country. About 90% of our foreign exchange earnings come from oil, about 60% of government revenue from oil, while oil constitutes about just 9% of GDP. Now, for businesses to expand, they need foreign exchange to buy critical raw materials, to buy machineries, and those machineries, you can't find them in this environment, so they have to import. So if you want to address the critical issue of unemployment, which is also a major issue driving insecurity and banditry, then you need to focus, deliberately focus on those organizations, those areas of the sector where you can pump in foreign exchange even while it's scarce. Pump in foreign exchange, they bring in machineries, they produce, they expand. Then you are not only solving the issue of unemployment, you are also, on the other side, solving the issue of government revenue. Because as businesses expand, government will pay tax. And as people are getting employed, you are solving the issue of unemployment. And those staff
kind of
also.
a value chain.
Exactly. The impact of that one intervention will have a rippling effect on so many issues.
Right. Now, we know that, well, sometimes manufacturers have often complained about some of the policies that the central bank had put in place, particularly, checkmating what item can access the foreign exchange market.
Yeah.
I mean, we have some of them that are being banned from accessing foreign exchange.
Sure.
Yeah. So, but what capacity do you think the manufacturers have to produce what should be actually locally produced in Nigeria?
I think the capacity is huge, and the potential is also very, very huge. Nigeria is one of the biggest countries in Africa, if not the biggest country in Africa, probably the biggest economy in Africa. And before now, the manufacturing capacity utilization is very, very high also. But those challenges that we have faced tends to reduce even the capacity utilization of those manufacturing. And as we have also escalated the government, there is gradual deindustrialization of the whole country because of those issues that we face. So the manufacturing sector, like other sectors, are poised to contribute effectively to this growth that we are talking about. Now, let's look at the issue of how well poised or how ready are they to utilize those foreign exchange. The AFCFTA, the African Continental Free Trade Agreement, will be coming into effect. It's already coming into effect, and implementation will start very soon. Even if those manufacturing sectors they don't have the capacity, then it's enlightening self-interest for us to deliberately boost their capacity so that they can produce and produce maximally. If not, we are creating a big problem for ourselves, because the country might eventually become a dumping ground for products and goods that will come from other services. So it's a two-edged sword. Either we support them and support them effectively so that they can contribute to GDP. And if oil, petrol is only contributing 9% to GDP, then I think it's high time we focus on those other sectors that can drive growth maximally so that we all move out of the quagmire. The second part of it is, if we don't support them, then AFCFTA will come into effect. the problem of unemployment that we have will continue. And then our country, unfortunately, might just become a dumping ground for goods that will come from other countries, further compounding the challenges that we have. So it's in our own enlightened self-interest. When we talk about the issue of foreign exchange, it's not giving foreign exchange for somebody to put in his pocket. It's foreign exchange for productive activities that we have identified and also made recommendations to government.
So what are you recommending for, better, implementation of this AFCFTA?
And we said, one, we need to create awareness. Engagement is ongoing, and thank God government also have recognized and also accepted that, look, engagement needs to go on. Then there is need for proper engagement of the citizenry, proper engagement of MSMEs, proper engagement of critical stakeholders in all sectors of the economy, then deliberate support for those sectors, all the sectors, so that we can create an environment where they can be competitive. Because once the borders are open, even when there are rules and there are protocols guiding the AFCFTA, you still need to protect your own industries so that those coming from outside will not render your businesses uncompetitive. And as they render them uncompetitive, jobs are being shipped out to those countries and then leaving you as a dumping ground for so many goods that ordinarily you could have produced.
Right. Now, your group also noted high and rising unemployment as a ticking time bomb. I guess it has exploded with the insecurity situation that we're beginning to see in the country. But then, as an employer of labor, now you represent NECA, that's Employers Consultative Forum. From your perspective as an employer of labor, where is the problem?
Before COVID, there are issues. There are issues, and we must commend government for the deliberate effort that government has made, and the deliberate effort it made during COVID, and also the various interventions that are ongoing. But COVID came in. We were just coming out of a recession a few years ago, and then COVID came in. COVID-19 came in, and actually created another kind of panic, another kind of challenge, a novel challenge, we call it, that even government have not experienced before. So addressing those challenges, certain policies came up, certain policies were knee-jerk policies, and government was bold enough to actually reverse some of those policies and also akin to recommendations of the private sector in addressing those policies. Now, the main source of our foreign exchange, as I mentioned, is oil. The main source of government foreign revenue. And then there was a glut in oil price. That stopped the flow of government revenue. And that affects every form of business that government is doing. And those that are government vendors, those that are government contractors, they also suffer the backlash. Organized businesses also suffer the backlash because of the lockdown. And because of the global village. The world is a global village. Whatever happens in China, whatever happens in the US, whatever happens in Germany has an effect on the economy. So we came out of recession, ran into COVID-19 with its own complexities, compounding the issue of unemployment. Many businesses, as we mentioned here last year, we did a survey with the International Labour Organization, and it showed significant number of businesses actually closed down, compounding the issue of unemployment. Now, COVID is still with us, and most of those businesses are still struggling to come back. So those that have lost their job during those periods, they are still struggling to return back to job. Now, the rate of our population is very high. We are churning out graduates on a regular basis, and we are not creating jobs.
Graduates with a sound education?
Now, that will change the dynamics of the conversation. The employability of the graduates. That's a different conversation entirely. But the reality is that we have so many universities, close to 30, 40 universities, churning out graduates on a regular basis. And those graduates are coming out to the job market, to the labor market. Now we call it the favor market. They are all coming out to the labor market, and jobs are not being created at the same rate at which those graduates are coming up. So the natural consequences will be, if you are not creating jobs and graduates are coming up, you keep building a repertoire of unemployed graduates.
So how do we begin to address this situation? Because when you talk about insecurity, in the country. I mean, it boils down to high level of unemployment.
Yeah. Now, three ways to address these issues, and as my principals have said, they are not rocket science. There are two critical employers of labor, two platforms where that generates employment. First is government. Government is an employer. Then the private sector. Then you look at the MSMEs, the small and medium-scale businesses that own their own businesses, and call them, for the purpose of this conversation, let's call them entrepreneurs. Now, if government cannot sufficiently create jobs to meet the needs of the populace, then the second level of attention you should focus on is the private sector. And it has been said over and over that for every 10 jobs, the private sector creates 9. Now, the attention should be, let's focus on those that can help us to mitigate those challenges. And that's why the issue of the access to the intervention funds came up, access to foreign exchange came up. Let's deliberately support those sectors, the organized private sector, to help us to create jobs. The more we support them, the more they expand, the more they create jobs. As I mentioned earlier, the more they create jobs, the more they expand. Government is also getting tax from revenue from the businesses and also getting tax revenue from the employees. Then we also focus on the MSMEs. Let's create an environment where MSMEs can thrive. And the MSMEs are basically the drivers of development in most developed countries. So let's look at the organized private sector as one focal point, and let's look at the MSMEs as another focal point. Deliberate policies to support them will take us gradually, or we create a path for us out of this cogwheel. And like a popular politician in time past said, you cannot shave my head behind me. So if you are coming up with policies for the private sector, it should be instructive that the private sector should be involved not only in the implementation of those policies, but also be involved while those policies are being crafted.
Okay. All right. Another key issue here is attracting foreign investment. What are the recommendations here?
Now, if I'm, let's create an hypothetical situation. If I'm an investor and the truth is we need private capital to support the investment plan of this country. Let's assume I'm a private investor. I reside in the US. I have billions of dollars to invest. I will look for an environment that is safe and where I can get returns. And in Nigeria, we have the population, we have the rich, we have the market. Then second thing I will look for is probably call a colleague that is running the business in that environment.
And wonder how it's doing.
How is the environment? How is your business doing?
Yeah.
Beyond what the regulators will tell me is testimonial of how I'm running the business. We also influence whether I'll bring my capital to the country, to that country or not. So the recommendation for us and the recommendations that my principals have made is this. Let's create an environment that is favorable, that is enabling for businesses to thrive. The regulatory environment must be favorable. Regulators must enable businesses and not be seen to be stifling businesses.
All right.
All right.
Thank you very much.
Thank you so much for coming on the program.
Our pleasure.
Mr. Adewale Oyerinde is the Director of Membership Services, NECA.
Thank you.
Great to have you.
Thank you.
All right. So commodities market update is next. Do stay with us.
We now look at the commodities market space, and we have Desola Sumoni, one of the research analysts with Financial Derivatives Company. Thank you very much for joining us this morning, Desola. Good to see you.
Thank you, Chimeze, for having me. It's good to see you too.
So we've seen the price of Brent crude in the global commodities market maintaining an upward trajectory. In fact, as of this morning, getting up to $75. Is this all about demand and supply?
Thank you for that question, Chimeze. Like you know, there's a strong bullish trend in the sentiment in the oil market at the moment. There are strong indications that the recovery in oil demand will significantly outpace oil supply growth. Some analysts have forecasted that the oil market is expected to remain undersupplied by about 900,000 barrels per day for the next 12 to 18 months, which has led them to forecast, $100 oil in 2022. In addition to that, we're also seeing factors such as, vaccine rollout at pace, pick up in international travel. We're seeing huge demand coming from the summer driving season in North America. And generally, the recovery in the global economy is also pushing demand for oil. On the other side, however, we are seeing, this bullish sentiment is mounting pressure on OPEC Plus to release some more oil into the market. We're also seeing China reduce, cap the import capacity of private refiners in the country. And for context, China is one of the largest importers of crude oil globally. And we are seeing talks. We are seeing expectations that the Iran and the US will reach an agreement on the nuclear deal shortly, despite the pause in talks. But the expectation that talks will recommence in a couple of days. And once an agreement is reached, Iran is able to supply them. So to supply about 1 million barrels per day into the market for the next 6 months, and that's just coming out of their crude stockpile. So overall, there's bullish sentiment. The oil price is expected to remain elevated. In fact, some analysts expect it to average $68 per barrel this year and around $75 per barrel next year.
Well, speaking of projections, Bank of America is calling for $100 per barrel in 2022. How sustainable is this bullish run?
I think there's room for oil recovery. To be honest, there are still some coronavirus restrictions globally, and that is still putting a cap on oil demand growth. So I think there's room for it. I think it is very possible to see $100 oil. However, there's also what they call this green revolution, with people thinking more about clean energy, clean oil, and things like that. So that may affect the sustainability of $100 oil, but that I think it is possible for oil to reach $100 next year.
Okay, let's look at other issue there. The United Nations Conference on Trade and Development released a report yesterday that showed global FDI slumped by 35% to about $1 trillion in 2020. However, FDI inflows to Nigeria increased slightly by about 3.5% to $2.4 billion last year. What are your initial thoughts on the report, and how can Nigeria boost FDI inflows?
Okay, so first, like I said, FDI flows globally declined 35% year on year, driven by coronavirus-induced lockdowns. We saw a slowdown in completion of existing investment projects globally, as well as a pause or a reassessment of new projects globally. In fact, new project announcements declined 42% year on year. We saw, but this decline in FDI was driven mainly by developed countries. FDI to developed countries was down 58%, driven mainly by declines in FDI flows to Europe, which was down 80% year on year, and North America, which was down 40% year on year. For developing countries, we saw a more resilient impact. For instance, flows to developing countries in general was down just 8%. But when you look at regional variation, you see some uneven effects. For instance, in Africa, flows to Africa was down 16%, Sub-Saharan Africa was down 12%, but Nigeria, like you said, was up 3.5%, and mainly was driven by inflows to Lagos. 85% of capital importation last year went to Lagos, and particularly to Lekki. So we saw inflows to FDI inflows to Lekki free trade zone. We saw also some investments from China in the Lekki deep sea port, and some investments from MultiChoice in, I think, King, which also improved the FDI flows. But I think that if you look at Nigeria's capital importation mix, FDI is only a small portion. For instance, last year, from the NBS report, FDI inflows to Nigeria was about $1 billion, compared to foreign portfolio investment, which was about $5 billion US dollars. So see, FDI is a small component, and that's due to many reasons. One is the regulatory environment and policy uncertainty, and the fact that investors cannot predict what the policy environment would be if they bring in their investment, the fact that they cannot anchor their policy expectations. I think that's one of the reasons why we are not seeing as much FDI as we could. And I think that if the government can look towards, helping, creating an enabling environment, like we say, for businesses to thrive, I think we'll see more foreign direct investments.
Market, the Naira depreciated marginally by 0.4% to close at 500 Naira to a dollar, the parallel market, while the level of gross external reserves also declined to $33.79 billion. This is also coming as summer holidaying resumes in full swing. What are the implications of this, and where do you see the Naira going forward?
Let's look at the big picture first. If we look at the external sector, we see that the trade deficit has widened significantly. It widened, I think, by 44% quarter on quarter, and more than 1,000% year on year to about 3.5 trillion naira. If you look at also the current account deficit, that also widened in Q4 2020 to about $5.3 billion. So overall, we can see that Nigeria's demand for FX significantly outweighs its supply of FX, and that is mounting some pressure on the currency. Also, late last month, we saw the central bank adopt the NAFEX, which was at 410, and there was initial market reaction, which was panic buying. We saw front-loading FX requirements. And we saw some speculative attacks on the Naira, which is still why the Naira is as depreciated at the parallel market. But going forward, I think that the higher oil price, I think, is very, very positive for Nigeria in terms of FX inflows. And also, the central bank is trying to clear up some foreign portfolio investment backlog and trying to inject some FX into the market to ease some of the pressure on the currency. I think that is positive, although we expect some demand to hit the market from summer travelers. But because of many countries around the world are not fully open for tourism. I mean, some are open, but they're not fully open for tourism. So we may see a slight decline in international travel coming from Nigeria, and also the exchange rate is a little bit deterring. So we may see a smaller increase in demand for FX for international travel. But overall, I think that the Naira would appreciate towards the end of the month and towards July. In fact, we forecast that the Naira will trade between $470 and $490 Naira to the dollar by the end of next month.
Now, we have seen the adoption of a unified currency for West Africa, the ECO, being postponed for the fourth time since 2003. Now, do you think the ECO will finally be adopted in 2027 now?
That's a deep question. I think that first it's not surprising that it was postponed because of the havoc that the pandemic wreaked on many economies last year. They were not able to meet the criteria for the adoption of the ECO. Just for context, there are six criteria, four major ones actually. One is external reserves should have import cover of at least 3 months. Nigeria's import cover is about 8 months, which is good. Inflation should be in single digits. Annual inflation should be in single digits. Nigeria's inflation is average about 16-17% for 2020, or this year to date is about 16-17%. Then fiscal deficit should be less than 3% of GDP. Nigeria's one is currently about 5% for 2021, and it was 5.4% for 2020. And the last one is the central bank's financing of the fiscal deficit should be less than 10% of the last year's tax revenue. I'm not sure how Nigeria is doing against that, but Nigeria is struggling to meet some of the requirements, and many other countries are struggling too. So that's why it was postponed. Whether it will be adopted fully in 2026, 2027 is is a big question that I don't know the answer to. But now I think many countries are focusing on mitigating the negative effects of coronavirus pandemic on their economies. And this postponement gives them time to align their incentives, align their objectives, align fiscal policy and monetary policy, and to adopt the echo. But again, there's still, strong debates about the positives or the negatives of adopting the single currency. On the positive side, there's the argument that to promote trade, it would ease up payments, it will reduce cost of transactions, it will promote regional integration, which is good. But on the negative side, there are questions that Nigeria, some people, because Nigeria is the largest economy in this region, that Nigeria would dominate. There are concerns that Nigeria would dominate the monetary policy making. There are concerns that West Africa has nothing to trade with each other. So most of them are commodity exporters like Nigeria, so they have nothing to trade. And except and a single currency would not automatically or magically facilitate trade. There are some infrastructural issues that need to be addressed. For instance, the road networks between Nigeria and all of these West African countries need to be improved to really facilitate trade. So those are some of the issues that we are considering.
Speaking about the commodities market, how would this impact the commodities market within West African states?
Good question, like you said, it is what do we have to trade? I think that's the biggest question. Nigeria's trade right now is mostly oil, and many of these West African countries they're not buyers of Nigerian oil, right? So the question is, what can we trade? And except we move from just being exporters of primary commodities to creating some value-added services, except we really boost our manufacturing sector to have some value addition. I think there's the trade between West African countries would be still limited, and it would have a very little impact on the commodities market. Although there are talks that once this has happened, and if Nigeria cannot boost its manufacturing competitiveness, Nigeria would be a dumping ground. There's that argument, that dumping ground argument. But the same is true for other countries, and there's also the positive of having this access to these bigger markets.
I thank you very much, Desola, for your time with us this morning. We do appreciate it. Thank you.
Thanks for having me.
Okay, let's have our opening call to the markets with Will Ibong. Well, Will, it will be interesting to know what exactly happened at the equities market yesterday. First, it was green, and all of a sudden, it turned red.
Good morning, Chimi. What can I say? It was a surprise as well. The large caps takes the pace in the markets. I was surprised to know that the equities market started this week's trading in the red territory. It gave up the earlier gains, like you mentioned, observed that intraday to close negative. Now, let's see what the numbers are saying. The all-share index declined by 0.27% to 38,545.30 points, while the equity cap was at 20.089 trillion naira. We see that the market cap of listed equities lose about 54 billion naira in yesterday's trading session and barely hanging on to the 20 trillion mark. This decline was driven specifically by late sell-offs of Boa cement stocks, down by about 2.8%. That's why I said the large caps are dictating the market. This has moderated the month-to-date gain to about 0.3%, while the year-to-date loss increased to 4.3%. The activity levels were also mostly in the decline. But to give us more insights on the activities in the equities markets is Mohammed Kayode, stockbroker at APT Securities Limited. Good morning, Kayode. Welcome to the show.
Good morning. It's a pleasure to be here with you.
Wait, Kayode. We're all worried and we want to know what happened. We are quite intrigued. What would you say triggered the steep sell-off of Boa cement stocks?
In the market, you see, I have always been saying this, that the market is moved in banks, in step and bank. And this kind of scenario is not expected. What happened is was not expected. When you see the situation where the market is on the the market rate is still positive, you have a trigger against 17 years. So it's going to happen in some of those 7 days. For me, I believe that the market is on is still showing the green projection. So I believe that the market still will just reacted to what happened in the market yesterday. But to me, the market is still good and it can still move in the green direction from now to the end of the week.
Oh, thank you very much, Kayode, for your insights on the program. Now, to talk more about it, we said the banking sector, at the unlisted markets rather, we move to the unlisted markets to see that the NASD index at the market cap was closed Monday's trading session negative. The NASD index decreased marginally by 0.03% to close at 745.88 points, while the NASD cap closed at 530.18 billion naira. Total volume traded was at 2.88 million units, valued at 18.69 million naira. It traded in 62 deals. This represents the decrease in the volume and value represents a 44.06% in value and 0.86 in the volume, and that's a lot of a drop in the market. And of the 5 securities traded yesterday, the Nigerian Exchange Group PLC was the only advancer, and its share price increased by 0.26% to 19 naira 33 kobo from 19 naira 28 kobo. VFD Group PLC was the most traded securities by volume, while the Nigerian Exchange Group was the most traded securities by value in Monday's trade. In the fixed income market, trading in bonds was bullish as the average yield declined by 7 basis points to 11.9%. Across the curve, average yield contracted at the mid and long segments as investors took long positions, and while yields were flat for short-dated bonds. To talk more about this performance in the market, we have Ajibola Ero Phillips to talk to us this morning. Good morning, Ajibola. Welcome to the program.
Good morning. Thank you for having me. How are you guys?
Could you tell us what's driving the quiet trading sessions in the fixed income markets in spite of the OMO maturity of 15 billion naira?
Most of it is really just about liquidity position in the market generally. The market has really been, there's not been that much of liquidity in the market. But again, there's a maturing bond in July, so we might see a bit of activity at the bond auction that is expected to happen tomorrow. Even though we don't expect subscription levels to be, fully higher than what we used to see in the past, but we'll still expect the bond will be, be oversubscribed up to a certain level just because people would tend to roll over the maturing funds. We have about 561 billion in maturing July 15th, 2021. So expect all of that to be plowed back into some of the bonds that are going to be offered at tomorrow's auction.
So are we going to see more cherry picking on select bonds like in the auctions?
Not so much. It's just that generally the market, especially in the secondary market, has been rather quiet. The large players are playing more in the short tenor space. That's on bills and then on in fixed deposits with some of them.
Thank you so much, Ajibola, for your input on the program. That was Ajibola Ero Phillips, FX trader at FBN West Merchant Bank. Well, that's it, Jimmy. That's what we have for the markets.
All right, let's hope for a profitable trading day today. Thanks, Will. All right, we'll take a quick break, and when we come back, we do an opening call to London. All right, let's get some updates from the street of London with Juliana. Good morning, Juliana. Well, data from the ONS this morning shows UK borrowing dropped to £24.3 billion in May. What factors contributed to this decline?
Good morning, Chimizzy. There are lots of different factors, but I think the main one really is the opening of the economy. Things are starting to open up again, which means that the burden of the government expenses, which was certainly the furlough scheme and all of these bounce-back loans and business rates relief, are starting to wind down. It's an eye-watering sum. Over £24 billion is what the government borrowed in the month of May. But if you compare that to May last year, it's £19 billion less. Government borrowing in the UK currently stands at about £2.2 trillion, which is over 99% of GDP. So it is still an eye-watering figure. But Chancellor Rishi Sunak pretty happy with these figures, and so is the City of London, which is why it's trading in positive territory at the moment. There has been some speculation that perhaps the long-awaited rise in taxes may not come, because if government tax receipts can start piling up as people start coming off of the furlough scheme, then the recovery may not need a hike in taxes and may recover itself naturally.
And Britain is to start negotiations to join the Asia-Pacific Free Trade Pact. What will this mean for UK businesses?
But it's good. I think it's definitely seen as more of a strategic movement than an economic movement. Some estimates have it as it giving 0.1% to Britain's GDP over about 15 years. But this is the prize that Brexiteers have been long dreaming of. It covers about 500 million people. British businesses who are exporting cars, manufacturing equipment, as well as beef and lamb. They'll be able to access a pretty lucrative zone, and Britain will be the first member outside of the Asia-Pacific region to join the, and I should get it right, the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. That's what the full name is. And they'll be the first region to join it. So it is really good. Obviously not as important and not as lucrative as what the former EU relationship is, and it's not as important as what a free trade deal with the US will be. But Dominic Raab, the Foreign Secretary, he's in Hanoi, Vietnam. He is going to be taking over from Liz Truss, the Trade Secretary, to try and get this deal signed and delivered. So, yeah, certainly seen as a strategic win for Britain.
All right, Juliana, we'll talk to you again later in the day on Business Incorporated.
Thank you.
For now, let's look at the crypto markets with Ladi. Well, Ladi, Bitcoin forms death cross as sell-off shows no sign of reprieve. China has expanded its clampdown on cryptocurrencies, telling banks and payments platforms to stop supporting digital currency transactions.
Yeah, China is back again. Same thing happened in the last bull run, 2017, 2018. Was the same China FUD. And here we go again with China. Well, this is what it did to the market. Red. It's all red in the market right now. Bitcoin hit down, currently trading about 31,000, sitting on support. Fear, extreme fear right now in the market at 10 points. Incredible times right now. Market cap, $1.31 trillion traded. It hit $2 trillion previously, but it's been going down since then. Down 5% this morning. 24-hour volume, $128.82 billion traded in the total crypto market, up about 37%. Bitcoin dominance is inching up at 46.57%. At 8 a.m. this morning, Bitcoin was trading at 32,667 with $51.78 billion traded. Bitcoin is sitting on crucial support right now, around $31,000. Let's talk to Gilbert Jokpatan, our digital market analyst. Hello, Gilbert.
Yes, good morning, Mr. Ladi.
Good morning, Gilbert. Well, Bitcoin is sitting on a crucial spot right now. It's either it goes all the way down or up from here. But where do you see it going?
Well, right now, I think anything is possible at the moment. And technically, nothing has changed. We have been respecting the 30K support and the 40K resistance zone. So right now, sitting at the support, we expect a bounce to the resistance. But if the support zone gets broken, then it means we are going to begin a new trend. But right now, technically, nothing has changed. We either need to break below the support or the resistance for us to begin a new trend.
All right, Gilbert, but looking at this market right now, is it institutional investors taking profit?
Well, I rather think there is more of institutional investors manipulation at the moment. And there is enough liquidity below the 30K zone.
All right, but traders right now, is extreme fear in the market at 10 points. What should traders be doing at this point? Because we know this market, traders are very emotional. And it's fear right now, and they could drive this price lower.
Okay, that is really true. But as a long-term, once you're looking at the long-term perspective, I think these prices are good discounted rates. Just like MicroStrategy took advantage of it yesterday. But if you are looking from the short-term zone, if we break this 30K zone, then there is nothing to worry about. We can shut our way down. Otherwise, you just wait and watch for the market to have a new direction before we take action.
All right, Gilbert, but I want to know, what are you personally doing?
At the moment, I'm just waiting for us to have a new direction before I enter into the market. We either need to bounce off this support. Once we are bouncing off, I get in, or once there is a breakdown, I shut my way down.
Okay. But Gilbert, looking at the way things are going now, USDT stable coins are the ones in the top gainers. We have double-digit losses right now. So for traders that are down about 30-50% at this moment, what are they supposed to do?
They should huddle. They have to huddle. You don't want to sell at this point, because once we are back to the 50K zone and above, your only regret will be not buying enough.
So I guess it's either you're buying the dip or just watch or catching a falling knife, basically. All right, Gilbert, thank you so much.
All right. It's like
Great to talk to you. Well, top holds by market cap, we see BNB down 11% this morning, below the $300 range at this point. Dogecoin, ever since Elon Musk featured on the SNL show, Dogecoin has dropped 70%. Now trading at 20 cents this morning, down 21%. So it's a risky asset in a risky market at this point, because meme coins are not doing well at this point. So you might want to reduce your exposure in meme coins at this point. Look at the top 5 gainers. It's all stable coins. That shows you what is happening in the market right now. Look at those losses there. Doge, top loser there, 21% down. AMP down 20%. NEO down 18. Kusama down 18%. And T4, even though T4 had a good run, but you know, when Bitcoin starts acting all volatile, it will destroy any setup. Down 18 points there, T4. So, Chimi, the market is not looking good. It's not for the faint-hearted right now.
Absolutely. And for any potential investor or trader that want to get into the market, just as Gilbert said, is a wait-and-see approach for the market direction. All right, that's a wrap on the program. Thank you for watching. And don't forget to join us by 1:30 p.m. on Business Incorporated for more updates on developments in the world of business. I'm Chimezie Obi Iwago.
And I'm Ladi Williams. Thank you for watching.